Well, the MPC will be meeting today at a time where Nigeria's economic signals are mixed. Inflation has been slowing on a year-on-year basis. The foreign exchange market is a bit calmer than earlier in the year, and we see the S&P has actually upgraded Nigeria's outlook to positive, and key reforms have started filtering into macro indicators. Yet, the economy is still navigating tight credit conditions, fragile price dynamics ahead of the festive season, and an FX environment that remains sensitive to global shifts. So some expect a small rate cut. Others believe the committee will hold to allow September's decisions to settle. So what should we be looking out for? But I'm being joined by Oladipo Ajayi, Head Fixed Income and FX at Chapel Hill Denham Securities, and he'll be sharing his expert thoughts with us on the show. Thank you so much, Mr. Ajayi, for joining.
Yeah, good morning. Thank you very much for having me this morning.
All right, you're welcome. So with the Monetary Policy Committee cutting the monetary policy rate by 50 basis points in September to 27%. Now, the first reduction of the year is what we saw in that particular December. But then when you look at what has happened between, that's September rather, when you look at what has happened between September, when there was a cut of 50 basis points, and what obtains now, would you say that that key monetary decision was is actually justified?
Well, to be realistic, it was a marginal cut, and it's not something tangible that would have expected to actually cause any uproar in the market. And I think the decision in December is just to test water. The monetary policy guys just want to see what will it be like, what will be the sentiment if they actually start towing that line. So when you look at what has happened between then and now, it also shows that we've been on the right trajectory, because when you look at where inflation was as at the time they were sitting for the last meeting, inflation was not of 20% as at that time. And here we are now, inflation is already around 16.1% level. So it means that despite the fact that there was a rate cut, we still continue to see disinflation, and which also still means that they call it right as at that time when they were making the cut, and it was the right decision.
Apart from inflation, was there any other indicator that showed that there was a little bit of improvement in the economy? Because some people feel there was nothing to actually point out to say that whatever key decision that was taken in September outrightly or in a way influenced some improvements that we are seeing now.
Well, I think it depends on where we're looking at it from. If you look at what is happening in the market generally, the level of liquidity that is sitting in the market. Don't forget that the month of September, beyond the rate cuts, there was also a CRR reduction. What that means is that the central bank released more money into the hand of banks. So it simply means that they have more capacity to actually lend. It means that they also have more capacity to actually invest in instruments, whether corporate or sovereign instrument. And also, if you look at that meeting, the market was very tight. When you look at interbank markets, we barely can see huge liquidity sitting in the system. But post that meeting, we've seen a situation whereby the market is liquid to over 6 trillion. Yet there was no aggressive pressure on Naira. So it simply means that to a great extent, the markets already have confidence in the monetary policy guy. Beyond the market, international community also, they also agree and they're actually in line with what has happened. And don't forget that, like I mentioned, that 50 basis point is just marginal. If you look at where monetary policy rate was as at September, we're at 27.5. So cutting 50 basis point is not substantial enough to actually move a needle. And that's one of the reasons why we feel that the monetary policy guy needs to do more. But while they are doing more, they need to actually be a bit cautious so that they will not just throw caution to the wind, because the geopolitical crisis also is still there. There's still a bit of panic around the capital market as well. So they need to be careful while they're actually taking decision in line with that, because the end goal is to actually ensure that interest rate is at the point where it is easy for corporate, for business owners to actually borrow money, maybe from bank or from the market. and also to ensure that the cost of borrowing generally, beyond borrowing, the cost of borrowing also is actually very attractive. So I think that when you look at between September and now, we've seen a major shift in terms of liquidity in the system.
Okay, so we'll still dwell on that. You talked about liquidity, you talked about inflation. As at that September, the committee cited stronger output growth. They talked about a better FX condition. They talked about rising reserves as part of reasons for the easing as at then. But then pre-September and post-September, when you look at these indicators, would you say that they truly reflect a solid improvement in the economy, or were the gains still, too shallow, of course, between pre-September and now?
Well, if you look at pre-September, you notice that we were building a reserve step by step. And also, you also notice that we already had the central bank has been able to create an FX market that is self-dependent, and beyond self-dependent, is price determined. So it means that you don't need anyone to actually state where prices of the currency need to trade. Markets actually determine where currency price trades. And also, if you look at what has happened post that meeting also, same thing has happened, despite the fact that we noticed a bit of panic in the markets when the president of the United States made a statement around Nigeria. And also, when the market also find that unclear view around the CGT as well. Market reacted most majorly the foreign investors, and when they actually sell down some of their holding in the market, we felt a bit of pressure in the FX space. And for the way the market reacted around that time is enough to tell you that the market is actually very stable. And not only that market is stable, market also has capacity. Because before now, if you see a bit of demand around that side actually leaving the market, you put a lot of pressure on the market, and I would likely see that aggressive depreciation of the currency. But when you see what has happened post-auction, post that meeting, it shows that the market still remain resilient. We're seeing growth, and also beyond that, reserve is not up for 46 billion now, and before pre-September we're around just 41 billion corridor. So it means that between September and now, we've been able to do additional accretion to the reserve of about 5 billion, despite the level of aggressive outflow that we have seen in the month of November. So it means that the decision that was made at that particular point in time is actually still in line with market expectation. Because if it is not, I'm telling you, you would have seen the impact on the reserve aggressively now. And another thing that's also playing into advantage beyond the macros that's happening in Nigeria, not so because it's more like a global phenomenon now. We've seen the US Fed actually cut rates just last month, and also it means that it's actually a global line now because the global economy is a bit fragile. So what we are doing globally is to actually reduce rate to actually so as to stimulate growth, and that's exactly what we too are trying to.
Well, I guess we just lost communication with Mr. Oladipo Ajayi right there, even as he tries to help us understand the situation with the key monetary policy decisions by the MPC, and of course being pivoted by the CBN, how it panned out from September up to now, and if there are true justifications for this decision, of course projecting into the future as regards what the new decisions will be. I understand that Mr. Ajayi is back. So let's just quickly move on from here. Earlier on, you said that the rate cuts were pretty insignificant. But then this period was when we saw Nigeria's headline inflation slow to about 16.05%. Yet, many households reported that prices remain high. So why is there such a visible gap between the official disinflation trend and real market prices?
Well, you know one thing about inflation. Inflation is you compare month on month, you compare year on year, and to be realistic, if you sample market opinion, of course, people will still say prices are still very much high. But when you pick some key indicators to actually check, Lincoln, by this time last year, I remember really that a bag of rice was selling for over 19,000 naira. And currently the market price is around 60,000 naira. It means that one way or the other, we've seen drop in price in prices of items or such. And also don't forget that this is more like an harvest season. And it is normal for you to actually see prices of food to actually drop around this season, and you expect that to also impact as well. And also another thing also that we also need to consider is the fact that there's also high base year effect, and that also will also affect the inflation figure as we speak currently. Because when you look at where we were last year and we are comparing what we are currently doing now, of course, it will simply show that inflation is actually dropping. And it's not only peculiar to Nigeria, it's a global way of actually determining inflation. Inflation does not necessarily mean that prices are not going up, but it means that prices are going up at a reducing rate. So, and that's when you are comparing month on month, you are looking at it in the month of June, it went up by this quantum, but in the month of November, it has gone up by a lower amount. So it doesn't necessarily mean that price has dropped aggressively significantly across the board.
Okay.
But it could also mean that it's actually increasing at a reducing rate.
Okay. Now, to wrap up on this, analysts disagree on the next policy action. So should the MPC deliver another small cut of maybe 25 or maybe 50 basis points, or hold the rate at 27% to properly assess the September decision? What do you think?
I think I will go for a 100 basis points.
100 basis points. Why? Why would you go for that?
So one of the reasons why I would go for that is that if you look at, like I mentioned earlier on, as of November, when the MPC was sitting, inflation was at 20.17%, and currently inflation is about 16.1. So it means that inflation has dropped by about 400 basis points. So I won't be surprised if the monetary policy guy directs to actually do like a quarter of that drop, which is 100 basis points, to actually reduce rate. And don't also forget that one way or the other, the monetary policy rate is actually altering the system. Corporates that actually want to borrow money from the bank, they actually use this as a metric to actually judge what rates fund will be extended to corporate customers. So I feel that on the part of the monetary policy guys, also they're also looking at it from that angle. If you do another this one, that's not in any new do.
Okay.
And currently, Nigeria economy is stable to a great extent. So I think that 100 basis points will be my own call.
Some people actually disagree with you when you say Nigeria's economy is quite stable. Some people have talked about the fact that we're still having a bit of volatility in oil production, oil price. We're also seeing some volatility in the FX market. It's not outrightly stable that way. But then, like you said, 100 basis points. Some people even talked about 100 basis points. But then we are going to wait and see what the decision will be at about 1:30 thereabout, because New Central will be bringing you live feeds about the time the MPC meeting starts to share the details with you and, of course, talk more about this. So, Oladipo Ajayi, I'd like you to stay with us, all right, because we're going for a break. And when we return, we'll now look at the other side of this conversation, and that is the Lagos State Governor that is set to present about 4.2 trillion naira 2026 budget to the State Assembly, rather. We want to look at that particular amount and what it can do for the state. We'll be back in a bit. Now, Governor Babajide Sanwo-Olu, Governor of Lagos, is presenting the 2026 appropriation bill this morning to lawmakers. And while we look at the current budget, how it had performed, we will also be looking at what we should be projecting for in terms of this new fiscal dispensation, of course, in a bill that the state lawmakers will be ratifying. Now, Oladipo Ajayi is still with us, head fixed income and FX, Chapel Hill Denham Securities. And we'll also look at it. So, Oladipo, for you, what are the key priorities and sectors targeted in Lagos State's proposed 4.237 trillion naira 2026 budget?
Well, I think that will actually spill from what happened in the year 2025 budget. Year 2025 budget is about 3.2 trillion, and so it simply means that the current budget is like $1 trillion over what was actually budgeted for the current year. And I think the key aspect I think the budget should focus around is number one, infrastructure. That's actually very necessary. And because currently, if you actually need to develop an economy, you need to actually provide adequate infrastructure. There's a lot of things that still need to be done in Lagos State. When you look at the transportation system, is not actually well enough. There's still more than enough that the government said to do in that regard. And I think number two will be educational sector as well. The government needs to work around that aggressively. You need to improve the standard of education in Lagos. And I think everyone wants to see Lagos where there's no huge disparity between a private school and a government institution in Lagos State. So the government needs to actually work around that as well. And this budget needs to cater for that, improve the quality of education that's being given out, improve the quality of teachers, improve the quality, the life of teachers as well. And also beyond that, Lagos State also needs to find a way to diversify the economy overall. When you mention some states, there's something that comes to the mind. So on the part of Lagos, what comes to your mind when you talk about Lagos? Is it only about business activities, only taxes for business activity? So what is Lagos State doing to further diversify their income line? And I think this current budget should also look in that line as well. And I also feel that also the security aspect as well. We understand what is happening across the nations, and also, so I felt that considering the level of population in Lagos, this budget will also cater for adequate security as well, because when an economy is not secure, of course, the likelihood that you will attract foreign direct investment is actually very slim. And when you look at Nigeria, the first point of call that comes to the mind of investors is Lagos. And so when Lagos is not safe, of course, it means that there won't be inflow of investments in Nigeria. So I think that this budget will also cater for that as well. And also, finally, electricity. And now that the government is trying to actually allow states to actually provide electricity. I think Lagos State should pioneer this aspect, because if you really want to develop the state, you need to ensure that there's adequate security, adequate power supply. And these are some of the things that have been inhibiting the growth of businesses in Lagos. There are many businesses that would have grown beyond the current levels, but because there's no adequate power supply. So I think, and I know that this budget will also cater for that sector as well.
Well, interestingly, we saw a 26% increase in the 2026 budget from the 2025 budget in terms of the numbers. Do you think that will be able to deal with the issues and also, of course, ensure some sort of investments and growth, most especially in economy? You talked about infrastructure development, power, and some other areas that are critical to Lagos's growth.
I don't think that the budget is sizable enough, and my view is premised on the fact that when you look at a state like Lagos State, Lagos State should be running nothing less than between 25 to 30% of the federal government budget. So if the last federal government budget is not of 50 trillion, and so if Lagos State is just doing about 4.2 trillion, it means that Lagos State is doing less than 10% of federal government budget. And I'm sure by the time the federal government release the budget for the year 2026, I won't be surprised if it's over 70 trillion in that regard. So it simply means that when you measure that with what Lagos State has done, it means that Lagos State will be doing about 5 to 6% of the federal government budget. And when you consider the level of activity that is going on in Lagos should be doing something close to about 25 to 30% of federal government budget. So it simply means that we need to do more in Lagos State. It means that the leadership of Lagos State need to do more. They need to be able to think outside the box beyond federal allocation, of course, you need to also look at how to actually generate revenue internally without actually affecting the citizen of the state to a greater extent. And also, if the budget for last year is about 3 trillion, then also the expectation is that beginning next year, the new tax regime will actually kick off. This also should impact the state more. So it simply means that there should be more revenue coming to the coffer of the state's Lagos state government. And also, it also means that they have more capacity to be able to provide adequate services and to the populace of the state. So when you look at it from that perspective, I think that the budget of 4.2 trillion is not something sizable to actually cater for the Lagosians.
Okay, so let's just wrap up on this. Inflationary pressures, post-fuel subsidy, how do you think these two would actually impact the state's fiscal position in this new fiscal year? Just in about a minute, please.
Of course, when you look at where we were, just look about 4 years ago, the budget for Lagos State was around 1.5 trillion thereabout, and currently the budget is about 4.2 trillion. It simply means that Lagos had a better budget about 5 years ago compared to what about 4 years ago compared to what they are currently doing when you actually report this in dollar terms. So inflation, one way or the other, has actually eroded the currency, and also that's actually put pressure on it. And also the level of service that the government will be able to give this in terms of infrastructural development means that the government needs to spend more. So what we are doing, that inflation has actually affected this. And on the part of fuel subsidy, as fuel subsidy is more like the burden of the people. And it's the burden of the people is the revenue to the state government. But the government should now find a way to ensure that they use the revenue to reduce the impact on people. And that's why I talked about the transportation system. Imagine a state where there's adequate rail system.
Of course.
People will not feel the burden so much.
That's true.
That's why I said that the government can use the money to actually reduce budget.
Yes, and I also know that effective implementation and accountability would be key in seeing these budgets perform better than the previous one. Oladipo Ajayi, Head, Fixed Income and FX, Chapel Hill Denham Securities, thank you so much for your time.